If you think of the timeline of operating systems in financial services, primarily they're used to keep track of who owns a security or an asset, right? That's called a cap table. And 50 years ago, cap tables were kept on a piece of paper, held in a filing cabinet. Then they invented, computers and PCs. Then they were kept on a Lotus 123 or an Excel spreadsheet and kept on a computer. And then those computers moved to mainframes, and then they moved to the cloud. And this next iteration is just cap tables on a blockchain decentralized network.
All right, everyone. Thanks for joining us. We've got Anthony here from Provenance Chain to talk about real-world asset tokenization, one of my favorite topics and something that I think is a big deal. And a lot of people are still trying to figure out what exactly that means. Anthony, thanks for joining us.
Thanks for having me, Mike. It's a pleasure to be here.
Absolute pleasure for having you on, Anthony. So let's get right into it. Like when you talk real-world asset tokenization, when you talk about what Provenance Chain does, talk to me as if I was like a 10-year-old. How would you explain that to somebody?
So I'll take you back a little bit. So I spent most of my career at BNY Mellon, which is one of the largest, really Wall Street plumbing banks that there is. They are responsible for something like a quarter of the world's investable assets flow through their financial pipes. And it's a bunch of disparate systems, computer systems linked together by a bunch of very old processes that are managed by both people and technology. And, it's a trusted system in that when you place a stock trade, you're, 99.99% sure it's going to be, processed. And at the end of the day, you're going to get either your money or your shares. It's a trusted process. It's time for that trusted process to move to a truthful process. And we can do that with blockchain. The technology around blockchain has, certainly been an interesting development from a lot of places. The technology that people know is, of course, Bitcoin and some of the financial frauds that have happened in the cryptocurrency exchanges and things. But truly, the revolutionary potential of blockchain is to remake, in my humble opinion, to remake financial systems that exist today and disintermediate $9 trillion of financial services fees that come out of everyone's pockets. And the real world application to that is technology is inherently disinflationary, so it makes financial services cheaper. And very specifically, what is a cheaper financial service? Well, it's a lower rate when you take out a mortgage or a home equity line of credit. Right? It can do that by utilizing better technology.
So let's use an example. I liked your example of, I press a button and I purchase a stock. We're used to sort of this model that works most of the time, and then you get on a phone and you try to figure out what didn't happen or what didn't work, right? So you press a button, like you said, you purchase a stock, and your assumption is that everything worked in the back end. And most of the time it does. But what's really cool about blockchain, and I think people are still catching up to this, of how transparent it is in the sense of you can check and make sure definitively that what was supposed to happen happened. And you can do that cheaper and more efficiently than really ever thought possible or we've previously been able to do.
I mean, as you know, most financial transactions require multiple service providers, and each of those service providers, as I was saying, takes a small fee to move the process one step further. And separate accounts and separate exchanges and clearing agents and custodians ensure a proper audit trail. But they're expensive, and the intermediation exists solely to bring a redundant amount of trust into the financial system. And what we're doing, so the promise of blockchain is that investors can be appropriately protected while significantly increasing transaction speed and materially reducing transaction cost. And this is what we're doing in blockchain, right? So a lot of people are doing a lot of things, but this is what we're doing in blockchain. And it's because blockchain does two things particularly well. First, it displaces trust with truth, right? And that whole chain of intermediaries is, to ensure trust. But with blockchain, you have truth. Right. And that's a big step up in technology because it eliminates the need to trust anybody. And then also it enables riskless bilateral transactions without the intermediaries. So instead of you and I trading 100 shares of Amazon through our Charles Schwab and your Merrill Lynch broker, and it's settling now in one day, 2 weeks ago it was 2 days. You could send me stablecoin, I could send you my Amazon shares, and we could settle atomically, instantly. No one needs to be involved in that trade. We would, of course, need some kind of an exchange for price discovery, but really that's it. So think about who it disintermediates. It disintermediates custodians, broker dealers, introducing broker dealers, clearing agents, custodians. All these people have something at risk in this new world order that is being enabled by this blockchain technology.
So how big is the opportunity here for someone new to understand this problem and solving it? And, what is the spoils for the victor? What's the opportunity here for the company that can nail it?
Yeah, so well, that's a big question. So let's take a sort of a big step back. So my view of the blockchain financial services opportunity is predicated on the fact of really two truths, right? First, the global financial services markets are going to tokenize several trillions of dollars of financial assets over the next decade, right? I think that's a given. There's about $700 trillion of financial assets, in the world. Will they all be tokenized? I think they should be eventually, right? It should be the shared database for financial assets wherever you are. It doesn't make sense to do it otherwise. But let's say several trillions over the next decade. And then second, issuers, asset servicing firms are going to need a lot of help managing that transaction because it's very, very tricky. So to answer your question very specifically, where is all this going to happen? And from where, I think we have to look to the TradFi networks. And if you look at traditional financial networks from credit cards, everybody knows there's MasterCard and Visa and American Express and maybe PayPal's in the mix, so there's a very small number. If you look at things like custody banks and the security servicing infrastructure, in the custody world, 3 custody banks have something like 80% of all the custodied assets. So we think a global oligopoly of properly built layer 1 blockchains will dominate the financial services part of blockchain and crypto. I would think other use cases will have other blockchains. I think Solana for meme coins is a wonderful blockchain. Provenance is not built for spinning up meme coins the way that is. There'll be blockchains used for gaming. There'll be blockchains used for the metaverse. That is not our blockchain, and that's not what we are really built for. We're built for regulated financial services. So I think, all the world's financial services will be built on an oligopoly of layer 1 blockchains, and it'll be 2, 3, 4, 5 of them. They'll all be interoperable with each other, the way that MasterCard and Visa and Amex are interoperable with users and merchants. And off you go. So that's what we're working towards. We have a group called Provenance Blockchain Labs, which is helping asset issuers adapt to this construct, because as I said, the transition is going to be violent. There's a lot of vested interests in keeping the system the same, but those people who have vested interests, have a vested interest, right? Their interest is continuing to earn the fees that they continue to earn. And in that construct, the people who lose are the buyers of financial services, i.e. me and you, who take out loans and mortgages and use other financial products.
Yeah, and there's a lot there. It's cool stuff you're working on. And obviously, I believe in the multi-chain approach in future. The idea of just tokenization, let's start there. You mentioned that, right? Like, how would you define tokenization? How would you explain it to somebody maybe in middle school?
It's a new operating system. So everyone in middle school, they know they can turn on their computer and the Apple operating system or the Microsoft operating system pops up. That's really all it is at its core. Blockchain does 3 things really well. It registers, it ledgers, and exchanges data. And that data in our construct is financial services, but it doesn't necessarily have to be. So we're building an operating system. I think, several other blockchains are building an operating system for what they do. And if you think of the timeline of operating systems in financial services, primarily they're used to keep track of who owns a security or an asset, right? That's called a cap table. And 50 years ago, cap tables were kept on a piece of paper, held in a filing cabinet. Then they invented, computers and PCs. Then they were kept on a Lotus 123 or an Excel spreadsheet and kept on a computer. And then those computers moved to mainframes, and then they moved to the cloud. And this next iteration is just cap tables on a blockchain decentralized network. That's the way I think of, as simple as I can make it.
Yeah. I think of like the example of owning a stock, right? So it used to be you had to own this piece of paper and you had to call a broker and maybe you had to visit the exchange, right? It was very archaic compared to what we have today. But I think everybody that's familiar with like Web 2 solutions, like going on an E-Trade and buying a stock electronically, understands that there was this great progression of technology, right? So it was like, had a piece of paper, then I had a broker maybe, then I, had these centralized services like an E-Trade or an Ameritrade where I could go on. And oh, by the way, the fees associated with each of these things got smaller and smaller over time to where it's very, very minimum cost to buy or sell a publicly listed stock today. And I think, when I think of tokenization, I think, well, that's for that specific asset class, but really there's a vehicle that we can imagine that rapid progression for all assets across the board.
Yeah, and you mentioned stock trading, which is a great example, and I don't think we'll see, equity trading on blockchain networks anytime soon because of the vested interest and in the existing structure and the fact that you said it, it's free for the users and the users have a good experience when you go to a Schwab or E-Trade website. What no one talks about is, free is never free, right? The brokers are making money on payment for order flow. They're making money off your deposits. They're front running you in some cases, right? Where it's possible in a dark pool. And the back office, once you get past that slick, E-Trade baby user face, the infrastructure is still pretty antiquated. DTC is a monster organization that's owned by its members. Custodian banks are also a very large network, and it's just not efficient. You still have, reconciliation costs, which are people reviewing trades, and multiple parties. And although again it's free, it's really not free, and it's not absolutely. Every trade doesn't settle all the time, right? Their trades fail regularly. In blockchain, that wouldn't happen. There's really, in a properly built construct, there's no such thing as a failed trade. We can atomically execute, and it can be remade for the better. Now that being said, again, it works relatively well now, so it's not going to be the first asset class to be disrupted by blockchain. There has been one asset class to have been disrupted so far by blockchain, and that is home equity line of credit, and that asset class was disrupted by Figure and many of the largest mortgage originators who all operate on Provenance blockchain, and Movement Mortgage and Guaranteed Rate and Home Point. When you go to their websites and you originate a home equity line of credit, you have no idea it's being originated on a blockchain, but it is. Meaning the front infrastructure looks just like the E-Trade infrastructure, but the back office, the middle and back office, is on blockchain, and that's where it gets a lot more efficient than stock trading, for instance. And in the process, they're able to take out something like 150 basis points over the process of originating the loan. And then what happens after that is you put it into a warehouse with other loans, and then you take it out in an asset-backed security, group it, put it together with others, and you sell it off in tranches that are rated. And that allows for efficiency of capital, and that allows for relatively low rates. But in the traditional process, it's still pretty expensive because each step the loan moves, you need to audit it, and you need to do other things for it. In the blockchain world, Figure and its partners were able to take out 150 basis points out of that process, and by doing so, they could speed to market was a lot quicker, and they're able to lower rates to homeowners and borrowers because the process is less expensive. The intermediaries make less money. The borrowers save more money, and that's a good construct. That's I like to say we're not doing God's work in blockchain, but if you can certainly help homeowners and borrowers, pay for their kitchen or pay for their children's education, there is some good that can come out of disinflationary technology.
Yeah, and 1.5% is nothing to sneeze at, right? Like that's a significant amount.
And I think the whole process is like 3.5% or 4% of fees come out of that. So it's a material amount of the fee.
What's another? I love these examples. What's another asset class do you think is low hanging fruit and going to be one of the first ones where tokenization really takes hold?
So we like three distinct areas. So we're not huge fans of digital twins or taking something that exists in the real world, like a piece of art, and people do this and it's fine, but you're never going to get provenance to that actual real world asset, right? If it exists in the real world already, how do you know that it's not being changed? And IBM had a great supply chain commercial on TV a couple of years ago, where they put the strawberries on the blockchain. And so the consumers in the Whole Foods, she picks up the strawberries and, ooh, this is the strawberry that came from the organic garden in, Tennessee or wherever it came from. Yeah. You can't put a strawberry on the blockchain. Like at some point during the process, when it was in the truck, how do you know, Bob and Sally didn't exchange those strawberries for different strawberries. It's not a digitally native asset, is my point. Good use case of blockchain. I mean, sure, it's going to be useful because you can track payments and things, but you're never going to be able to track that real strawberry is the strawberry. Now, things we like are digitally native assets, so things that only exist on blockchain or in a construct that is blockchain native. So 3 areas in particular we're targeting first, and one is alternative asset funds. So you can be sure that you own the fund. Again, being sure that what the fund owns, if the fund owns real estate or the fund owns art or oil, you still have that extra layer. You don't exactly know that you're going to have title of that, but you definitely have ownership of the fund, of the private fund. And we like that also because you can only in blockchain, you can take out a NAV loan. You can use your position and you can borrow against it. So in a traditional private equity or alternative asset world, it's really hard for you to, let's say you invest $1 million and you have to hold the investment for 7 years, and at the end of the 7 years, you get your return. Most funds don't allow any ability to use that fund and borrow against it. So it'd be great, and a lot of people would invest $1 million, you can borrow at 20% LTV against that, get $200,000 and go invest in something else. In stocks, you can certainly do that. It's called a margin loan, but in private equity and private funds, you can't do that. On blockchain, you can. So if it's constructed properly and you have asset perfection, you can do a NAV loan and you can use that for other things, just like you can in the equity world. So if you can add new services, and this certainly does, we like that as a use case. It doesn't, just by tokenizing something, and I hear a lot of people say this, we're gonna chop up a $100,000 investment into $10 shares, and because it's $10 shares, we'll get a lot more distribution. I don't really buy that argument. I think if it's a type of asset that will be bought by institutions, it will be the type of asset that will be bought by retail as well. So just by chopping something up doesn't give you more distribution. It gives you a little more access, but not more distribution. But we do like, again, the lending. The second thing we like is loans, because loans can be spun up on chain, absolutely digitally native. The only place they exist is on chain. You have asset perfection to the borrower, the lender, and the whole payment flow. If you can put all that on chain, we think that's a killer use case. It's really what Figure and its partners have done. A HELOC is nothing but a loan. So we just had an announcement yesterday with a life insurance firm called Infinio, and they're doing really the Figure process, but they're putting life insurance policies on chain, and they're offering loans to the owner of the life insurance. So if you have a $1 million life insurance, you can go out and you can take a $200,000 loan against that, and pay it back over time, and you're only borrowing from yourself, paying back to yourself. And we think that's a great use case, again, because you have perfected ownership structures and a very clear payment schedule back to yourself. Moreover, if you pass away while you have a life insurance policy, the blockchain can do certain things when it knows that you've passed away. It can notify your next of kin. It can pay your policy out. It can do smart contract type things. Where you can't do that in the real world. In the real world, if your life insurance agent dies and you die at the same time, maybe you don't ever get your heirs don't ever get your life insurance. It's just a better use of technology. And then the third, we like all sorts of receivables. In the factoring and receivable world is really broken because there's no trust. The borrower and the lender don't trust each other, and they don't know that the borrower has not pledged the asset to 2 or 3 different customers. So blockchain, again, replaces trust with truth in that case, and it can materially lower factoring rates down from 40% to 5% or 10%. So again, doing good back for borrowers and lenders. So those are 3 of the areas we like, and we've got clients building in each vertical, and it's an exciting time to do this.
So I hear what you're saying is what you see as some of the most valuable use cases within your domain is unlocking value that has traditionally been locked up and being able to do different things with that, such as getting a loan or potentially doing something where you can earn interest on that value versus just idly sitting there. And then subsequently lowering some of these costs that are associated with concerns of a default by a third party, by having more accurate records and more assurances that each individual person or each party gets paid.
Yeah, that's exactly it. I mean, a couple of other areas. So we were in a working group run by McKinsey, and we debated with a lot of big banks and big asset managers. We debated the asset classes most likely to adopt tokenization, and all those use cases that I mentioned were in there: alts, loan securitizations, and receivables. But also, bonds are a big broken area. It's a very big market. You can't really go to the Schwab and buy a bond. There's not a lot of secondary market activity in bonds, and so bonds are pretty ripe for the falling as well. We've seen several issued on chain, largely in Europe, but it's coming to the U.S. I think the entire bond market will be remade on blockchain, and that'll be one of the first big asset classes. And then the one we haven't really spoken about is FX and cash and payments. And Visa, MasterCard, PayPal absolutely dominated the space, but at their core, they're basically intermediaries in a two-party transaction, and they take a very large 3% fee for their services. We were just at lunch, and my guest and I were talking about certainly in New Jersey, they've started to add the 3% credit card fee to all the bills everywhere now. In the last year, these things have exploded. So I don't know if it is everywhere else in the country, but certainly around here, you'll get your $100 bill, and there'll be a 3% fee added on top of that. So you pay $103 if you pay with credit card. If you pay with cash, you pay $100. And that's a way for the merchants to pass on the credit card fee to the people who are using the services. And I would much rather pay $105 for the lunch and not have to look at that credit card fee. But when I know MasterCard and PayPal are dinging the merchant and the merchant's dinging me, I just conceptually hate that. So that kind of fee is maybe the very, very early beginning of the end of the credit card networks. I mean, it's in your face now. What am I getting for that? And what do they do for that, right? I know they do fraud protection and lots of other things and short payments, but that entire process could be replaced with blockchain. So stablecoins are not the answer to that. The existing stablecoins, USDC and USDT, are the two popular stablecoins. There's $150 billion outstanding among them and a couple of others. They're not really scaling the way that they could because they have issues, and some of the issues are counterparty risk when you're dealing with a USDC or USDT. You don't really know what they're holding. And very importantly, in a 5% yield environment, they give no yield because a yield would turn them into a security. So the solution, and our partners are working on this, including Figure, and they have a registration statement filed with the SEC that's public. A yielding stablecoin governed by the regulated by the SEC with very clear deposits that allowed a peer-to-peer. We could exchange the token peer-to-peer. It was a stable dollar, and it paid us a daily yield. Then I think we have something. Then I think we're starting to truly revolutionize financial services in that, now I don't need a checking account. Do I even need a savings account? Do I need a treasury account if I'm an institution holding a lot of cash? You start to question the need for banks if this thing could be ubiquitous. I could go to Starbucks, I could buy a coffee with it. It changes everything. So I'm very excited about that future if we can get there. And I think we will, hopefully. And we're watching that space very closely, but that's also built on Provenance blockchain. And if we get there, it changes finance as we know it. And these are the revolutionary things that blockchain can do.
So let me play back a little bit of that for you. It was super
I'm ranting.
Yeah, no, it's good. It's good. It's just you're so deep in the problem. I love it. And I get to sit back and learn and then digest, and then spit it back to you and correct me. So, we've got these credit card fees. You've seen businesses starting to push back on taking these credit card fees on the chin, which I think, has historically happened. Occasionally, for instance, I'll go into like a 7-Eleven or something and they'll say, you've got to do a minimum purchase, right, to buy with a credit card. And that's, I think, the earliest exposure to there's a different set of parameters if you buy with a credit card, because us as a merchant, we're put at a disadvantage, right, if you use a credit card in some way. And now, as you're saying, some companies are even passing that charge along, and consumers are becoming more and more aware of this, which is credit cards have been marketed as these magical things where you earn points, but it's sort of like removes the magic, right? If I have to pay to use a credit card, then it really kind of does away with the idealization of just swiping a card and having a worry-free consumer experience. And so what you're saying is blockchain has a way to do this by reducing a lot of the fees that these credit card companies have charged. Some of these fees may be necessary. There may be some fees necessary in doing some sort of transaction, but certainly not 3%. You would say 3% is greedy and is why credit card companies do very well in the stock market almost every year.
They are some of the most profitable companies in the world, and they take a very small bit. It's an intermediated business. So I would say you could eliminate credit card fees with this product. Back to cap tables, right? Because everything starts at cap tables. The cap table of or ownership ledger of the stablecoin would be held on Provenance blockchain. The issuer would pay interest for every hour that you owned, because they know who owns it. If I wanted to transact with you, you sold me a pizza and I owed you $10. I don't think pizzas are $10 anymore, but they used to be. I could think of like a PayPal interface, right? A phone interface. I could send you $10. You could receive $10. The ledger on Provenance blockchain has just moved, $10 from me. Now it's $10 to you. There's nobody involved in that transaction. There's no brokers. It's a peer-to-peer transaction. Once you have $10 in your account, you give me the pizza. I go and I eat the pizza. I'm happy. We didn't have a bank or a broker or a credit card fee or a credit card issuer involved. I earned interest up until the hour that I bought the pizza. As soon as you bought the pizza, you started earning interest. There's no 3-day delay. You got your money instantly. You don't need to move it into a savings account because savings account pay 5%. You don't need to move it into a treasury account because treasuries pay 5%. You just keep it in your account, and it's free, right? The issuer of this stablecoin would make a small fee off the interest that it pays you. Tether is the most profitable business on the planet because all it does is, sits on your interest and takes your interest. This would give you most of your interest and take a little bit of a fee because that's still needs to be managed. The treasury positions and other assets that underlie the yield need to be managed, right? So that does deserve a fee. But the actual transaction is on blockchain, and it would incur, 3 cents a gas, regardless of the size of the transaction. Like if we did $1 million pizza or a $10 pizza, I think that the gas would still be 2 or 3 pennies. Blockchain doesn't care about size in that construct.
When we say gas, we mean the fee to do a transaction.
Yeah, you wouldn't see it. I mean, it would get paid internally, but that's the cost of the transaction. Like to change one owner of a ledger to another owner of a ledger is a very basic blockchain construct. Remember, it does registry, ledger, and exchange. This is exchange.
So let's pull on that string a little bit, Anthony. I want to buy pizza from you. I'm willing to give you $10, but I don't have $10. I get paid next week, right? And so I'm used to this credit card, not debit card. I'm used to using the credit card and catching up. So how do we tackle that problem?
Yeah, that's a different problem. So someone's going to have to lend you that money, and that'll be a lender. Yeah, blockchain can't solve credit and lending, of course. It can make it more efficient, but someone's still going to have to be on the hook to make sure that you pay them back at some point in time. So I'm solving debit cards, not necessarily credit cards. Credit will exist. I agree. I agree. Credit will exist. It doesn't have to be as expensive though.
Well, yeah, and one problem at a time, right? But I think that's an important delineation. This really solves. I have the money. I want to pay in a convenient way with the money I have, and I don't want to be charged expensive fees for doing that. But this does not solve the problem of I don't have the money, which obviously this is a big problem. I don't have the money, but I want to spend money I don't have yet.
Yeah, that's true. Yeah, I would imagine the banks would spin up, their own rails there and lend you, 15-day money at a reasonable rate.
Sure, there'd be somebody that'll fill those shoes. I mean, and look, that's the exciting thing about crypto and Web3 that I don't think people see is, I always talk about it's a series, it's a group of startups, right? And you guys are solving one problem. There's certain problems you can't solve, but maybe your platform allows those problems to be solved. And then other startups or other companies or other protocols will populate and they'll go solve those additional problems. It's just, the movement of technology. And I actually find that many people don't understand this about the space. They just see, there's coins and there's tokens and they move up and down in value a lot and they really don't understand what's going on behind the scenes. And I always use the analogy, well, it's not even an analogy, it's true. It's like these are really smart people. They're CEOs such as yourself working on solving problems. And if they solve them well, they'll be a very valuable outcome for everybody involved.
Yeah, I mean, it's the most innovative industry I've ever seen. The ideas come at you every day. Surprisingly, the most surprising thing about being in my role is just the ideas that come to us from our incredibly passionate and evangelical network of users. Is things that I never even would have thought of when I took this job are things that people are building towards, and it's just it's amazing. Like one of the more recent ideas was using blockchain as a data repository for things that are time sensitive. So think about trade secrets. If you're a company and you invent a new trade secret, a new product or a trade, and you want to either take out a patent on it, but document the trade secret process. What you would do now is you would put a whole document together and you would send it to your lawyer's office and you get a stamp or you send an email to yourself. It's very haphazard. These guys are building a process on which you would you would send a package of the material. You would get put in what's called an encrypted object store, which doesn't sit on chain. It sits adjacent to chain, but it writes a hash to the blockchain that makes it immutable. Time and place, it's there forever. You can always look back. So if someone comes and said, I invented that first, and you get into a legal fight, you just point to the blockchain and say, listen, on June 2nd, 2022, we invented this. Proof, right? Truth. So that lawsuit has no merit. Who would have thought of something like that? But smart people are in the ecosystem and they're evangelical and they're thinking about things like that all the time, and it's incredible.
Well, yeah, I mean, look, I think the heart of crypto is, are you going to do what you say you're going to do? And the traditional system has been, yes. Why? Because I've done it a lot in the past, or because, I'd be a fool not to. But of course, every so often a bad actor comes along and doesn't do what they say they're going to do, sometimes over and over again. And it takes society or whoever's on the other side of that to time to figure that out, and there's costs associated with it. And I think thematically what we're talking about overall is there a system that can be developed for all these different, I'll do this, for it to not be an option for you to do anything else? And I think most people agree society would be in a better place if all those I will do it, trust me's kind of converted over to you're going to do it whether you want to or not, because you agreed to it and the system's set up that way.
I mean, that's exactly how we've built Provenance. So for instance, we even try to take out the use of smart contracts where possible, because smart contracts, whoever named them that was brilliant, but they are neither smart nor contracts at the end of the day. It's just little bits of code. So what we've done is we've built issuance and confidentiality and identity and exchange and interoperability directly into the blockchain software, the protocol. And it really, it eliminates the need for all these sort of bolt-on, I call it the Jenga tower of risk smart contracts. Again, making it simpler to exchange or to really trade truth for trust, right? You want to get to truth. You want to eliminate the need to trust, as you just said. And in a blockchain built for financial services, you can actually do that for financial assets. And it changes the game. It really does.
Yeah, I mean, look, I also want to highlight here, I do think that most people I don't know if you ever read Popular Mechanics or if you read it, but when I read Popular Mechanics as a kid, it's in this magazine, right, where they talk about all the latest scientific breakthroughs. And they always have this section that's like, in 30 years, what will the world look like? And it's always had like flying cars in there and different things. I do think, and I want to talk about what you guys have accomplished too, because I think it's not highlighted, but I think this is systemic of the recognition you guys haven't gotten is systemic of the problem in general, which is most people think what we're talking about is us ideating about the future and what could be. And they don't understand that this has already happened, that there's tons of institutions that are tokenizing assets on chain, that there are huge firms like JP Morgan and BlackRock that are participating in this, that already have assets on chain, and that chains such as yourself, while you're saying this is where we're going, you've also already had onboarding success with a huge amount in terms of dollar of assets. And so what I find is amazing in crypto is how often you talk to people about the space and they think you're talking about like flying cars of the future and what might be someday. And, oh, that's really nice that you guys think that might happen. And we're sitting here not understanding where there's a miscommunication because we understand it's already happening.
And yeah, the media, and I don't know if you count yourself among the media. If you do, I apologize. The media likes the stories, and FTX was a story, and Celsius was a story, and they were led by larger than life personalities, and that's what got the press, and that's what got people excited about the space for all the right and the wrong reasons. And firms like Provenance that are actually, again, at its core, we're building a financial services network. That's not inherently sexy, right? And it just isn't. I've been in financial services my entire career. I've never been called sexy, or what I've been called sexy.
I'll call you sexy, Anthony.
I've been called what I've done for my career has never been called sexy. But it's remaking the plumbing of Wall Street. I mean, it's not sexy. It's not supposed to be sexy, but it's exciting and it's reducing expenses and costs for borrowers or users of financial services. So from that perspective, it's really important. So Provenance, I'm going to, you queued it up. So I'm going to just, tell the audience a little bit about what we are. So we're a public open source blockchain network built for financial services. And as I said, we're building a modern shared operating system for asset issuers and investors. And as you mentioned, hundreds of financial firms use us like JP Morgan and Franklin Templeton and Apollo. At the large side, and on the small side, firms like Infinio, who I just mentioned, the life insurance startup. It's, I think it was the tip of the spear of remaking that $3 trillion industry. It's really interesting. We've got about $11 billion in assets, $30 billion in transactions. It's the second largest TVL, total value locked, behind Ethereum. And we're growing every day. And the reason we're not well known is because we don't have a token listed on a centralized exchange. Dogecoin, everybody knows them because people trade Dogecoin. Nobody trades hash, which is our token, our utility token. That's going to change towards the end of this year. We've announced publicly that we are planning to list it on multiple centralized exchanges. So look for hash, look for more from Provenance. But as we build this, there's no reason Provenance can't be a multi-trillion-dollar network, and I'm very excited about all that.
Yeah, look, and I want to highlight, from my world. So, we run a fund, as you know, and one of the key metrics you look at when you're looking at chains, especially chains that are focused on tokenization of real world assets or traditionally illiquid assets, is how much TVL, you can think of TVL as AUM, but it's how much in dollar amount is on those chains already, right? So there's, these chains that say, this is what we're going to do, but we haven't done it yet. And then there's these chains that say, this is what we're doing right now, and this is the traction we've had so far. $10 billion is a huge number, right? To give the audience and to give ourselves context here, like this is not a small number. The biggest chains out there, if you could name any of the chains, 10 billion would stand among them. And what was amazing to me is hearing that from, how we got introduced, hearing that from a counterparty and somebody that we're both very close with, and them saying this number 10 billion. And I was like, oh, I think I misheard you. Because I was like, I definitely would have heard of this project before if they have $10 billion of assets on chain. And lo and behold, I hadn't. And this is why I was so excited to talk about it. But I think it's important to give these contexts. Like, that's a large amount. And as you mentioned, you guys are working with some really impressive legacy financial companies that everyone recognizes, like JP Morgan.
Yeah, I mean, again, I think we are going to be one of the very few in financial services that scales. The conversations we're having are, I'll take a step back. The decisions at the big firms, the big asset managers and banks are made not at the boardroom, not in the C-suite. They're made in the risk committees. And I've sat in those meetings. Yeah, one comment from one person on quote unquote reputational risk can derail an entire project because you can never measure reputational risk. And you can never counter reputational risk because that person is just, quote unquote, looking out for our firm. And if that person wins the argument, the project literally stops, right? We're going to be on the cover of the Wall Street Journal as a fraud. We're going to lose our trust. Our shareholders are going to abandon us. You can't come back from reputational risk. So we're very focused on our reputation as being the preeminent blockchain network. I've heard, I've got a friend in a big top 5 asset manager. They call him Bitcoin Boy. He's the blockchain head of blockchain. He's a very serious person, but the traders call him Bitcoin Boy. There's a lot to overcome at the financial services firms, is my point. And to conflate a chain that has gaming and metaverse and meme coins, I just never see scaling in regulated financial services. So we're focused on that. And yeah, $10 billion, or actually it's $11 billion now, is a lot. RWA XYZ recently started tracking some of our loan assets, which are largely figures and HELOCs. And the pre-number was like 600 million. And the day after they started tracking it, the graph, which is pretty funny if you look at the before and the after, went from 600 million on one day on like a Thursday, and then on a Friday it went to 7.7 billion. And that's really the order of magnitude we're talking about. We're doing things multiples higher than have already been done. And we try not to, it's kind of a rule we have, like we don't talk about things until we've done them, right? So this Infinio $10 million of assets was coming for a long time. And they're like, let's do some press releases. We're like, once someone can point to the chain, see the assets, that's when we'll talk about it. And that happened a couple of days ago. So we just started talking about it yesterday. And there's a couple of instances like that. So we try to be the anti-crypto blockchain, if that makes sense.
I love that. Look, like I get asked this question all the time. I'm sure you get asked this question all the time. And it's very thematic to what we've been talking about this entire podcast. But, a lot of our investors ask, okay, if somebody says they have $11 billion of assets on chain, how do you know that to be true? And of course, I did a decade in venture capital where you're just having to ask for documentation from the companies you invest in or are interested in investing in. And you hope the documentation is correct. And you think, you hope that it's valid and all these things. This is another testament what blockchain solves. You mentioned it, but if you go to rwa.xyz, what is that? It's an analytics dashboard where you can see all these assets that have moved on chain, what chain they're on, where the assets flowing, what is in the details of each, loan or treasury or et cetera. And I think this is really cool because if somebody wants to do more research about the space, or if they hear this podcast and they say, I'm not sure if those guys are full of it or not, it's like, go look, right? That's the beauty of blockchain is you can go look instantly and know because of the nature of the blockchain and because it's transparent and open source, you can instantly verify what somebody's saying in terms of their success metrics, how much capital they have, how much assets they've originated on chain. You can verify it, in your pajamas at 2:00 in the morning. You don't need to pick up the phone. You don't need to talk to anybody. You don't need to trust anybody that they're not lying.
Yeah, no, that's exactly it. It's a whole new thing, and it's because of that. It's very usable, very exciting. And then take the next step with that data. So once that data is on chain, and as you said, open source and verifiable, there'll be various levels of permissioning. But once you have that, and then you have the data on the underlyings, imagine being able to run AI against that and getting out ahead of any financial crisis that's coming. Because now that you have billions of dollars of loans, you can start to say, okay, well, in the Southeast United States, credit scores of 650 and below have started defaulting at an 8% rate. Okay, we have to start watching out for or hedging ourselves for other credit defaults in other areas, right? You can get out in front of financial crises in a way that you couldn't in 2008. Like in 2008, you didn't know borrowers were defaulting until 60 days after they stopped paying their mortgages, right? And then all of a sudden the AAA tranches dropped to an A, the B's default, and it's the end of the world. If that data is on blockchain and you're again permissioned to see the data, the financial insights that you could have are unbelievably remarkable, like stuff that you could never do in finance before you can do now.
Yeah, I mean, look, it's three very, very, very powerful building blocks. Knowing that the data is right, having it accessible at any time, from anywhere is probably like the two core tenets. And then, the smart contract angle, which is if somebody commits to doing something on chain, they have to do it. When you combine those three, it's very, very, very exciting, what's to come, what can happen when you combine those three things.
Yeah. It's again, we're building the modern operating system for financial services. That's honestly the way I look at it. And try to punch holes in that argument. I mean, we might not wind up being the one chain that does it, or in the oligopoly. I think we will, but it's going to happen. I think whether it's us or not. And again, I think it's going to be us. But the oligopoly is coming, and we're going to be part of it. And at the end of that, I haven't even said the formula is simple. It's cheaper and faster, which blockchain does well, and everyone in blockchain talks about cheaper and faster. The third ingredient is safer. So cheaper, faster, and safer is how the revolution happens. And very few blockchains are talking about safer. And I'll give you a couple of examples. So at Bank of New York, from sort of day one, I was drilled that we needed to be what's called a good control location, which simply means you need to be a safe place to hold securities. Meaning, if I want to sell my securities on a very busy trading day when the market's dropping by 5%, those securities are available to me to trade. And from a tech perspective, it means you're always up, you're never down, you're always available. In blockchain land, it's a different construct because there aren't a lot of any redundancies really built into a blockchain, right? The chain has to operate; it can't. And if it halts, blockchains don't go down; they halt. They stop writing blocks. If a chain halts in the middle of a busy day, it should be seen as Armageddon in the community, right? So if Bank of New York, and you'll know, if Bank of New York went down for 5 hours, or State Street or Northern Trust went down for 5 hours in the middle of a trading day, Wall Street stops. You can't process stock trades. Maybe you can't get money out of your ATMs. It's the end of the world. And although there's redundancies and other banks would pick up the slack, when the stock of Bank of New York starts trading again, it's probably down material. I'm not going to guess, but a big number. Some of the blockchains that go down in the middle of a day, for 5 hours here or 3 hours there, token price doesn't go down. Maybe it goes up. Maybe it's flat. What it tells me is nobody's looking at them as good control locations, right? And in the financial services construct, that's all that matters. I would hope that if Provenance ever went down, we would get punished by the market, because we should. I'm not hoping that we go down ever, but we want to be seen as a good control location, is my point. And nobody obviously is looking at any other blockchain networks as good control location. So that's our goal. That's what we want to be. And we're working hard towards it every day.
Well, and it has to happen, right? Like, so if we're expecting more and more legacy systems and more critical systems to move on chain as technology progresses, then we need it to be more and more reliable and safer, as you mentioned, or there is dire consequences, right? And so, like, when you have these legacy systems that go down, the world's come to rely on them so heavily that that's why it's so disruptive. And I think, crypto still isn't at that point where, the traditional world stops. In fact, if you ask your average person, did you know a chain is down today? They're going to look at you and be like, no, like, I had no clue. I have no idea. In fact, even if they own that underlying asset that represents that chain, they may not know, right? And so, you have this separation of, crypto is kind of still in crypto island. And what I mean by that is it's specific only to crypto users and it's mostly solving crypto problems. But as more and more legacy systems come on, like the sectors you guys are targeting, it's going to have to be bulletproof.
Yeah, 100%. That's what we're working towards all the time. And, more and more use cases are on chain every day. So Figure is just about to release Figure Markets, which is a platform for trading crypto, among other things. And it uses Provenance as its ledger and its registry and exchange agent. So again, if the market is, down 5% and you need to get out of your ETH and the network's down, it's a really bad thing, right? So it's not what we're as you said, we're building to be bulletproof, and it's hard, right? And our construct allows us to do a little bit better. We're built in Cosmos. We've got the modules instead of the smart contracts that eliminate the need for smart contracts. Generally, smart contracts are written by third parties and placed on top of the protocol, and they're attack vectors for lots of disingenuous code. And we try to eliminate all of that wherever possible.
Yeah. Well, hey, we're rooting for you. If people want to find out more about the project, where do they go?
Yeah, we're on all the right channels. So you can go to, we're on X, we're on Telegram. Our website is provenance.io. Prov Labs, if you're an asset issuer, you want to build, provlabs.io. We've got a really good developer portal. Again, we're an open source public blockchain, so everything we do is online. We're active on LinkedIn and Discord and GitHub, all the normal places. And it's Provenance Blockchain Foundation is the way to find us.
Awesome. Well, Anthony, thanks for joining. And guys, we'll be posting this content at digitalwealthinsider.com as well as well as redistributing on all our channels and Provenance's channels as well. So stay tuned for that. Thanks, Anthony, for joining us.
Thanks for your time, Mike. This was fun.